This podcast is for general information only. If you're after advice for your own situation, it's best you chat with a licensed financial advisor.
Welcome to Aurellan's latest podcast that we've titled Intergenerational Thinking. I'm Anthony Edmonds, and today I'm joined with my fellow founder, Chris Leva, and we're going to talk about global equities and particularly focus in on the importance of style. So Chris, welcome.
Thanks, Anthony.
I'd have to say we're going to have to hit it out of the park today because, you know, our last podcast we had our colleague Rach Weld talking to Sarah Ketterer from Causeway Capital, and that certainly was a great podcast, right? So let's set the world on fire because we've got a high bar to live up to.
Yes, very big shoes to fill.
Exactly. And when we first set up Aurellan, one of the things you're really adamant about was building a global equities fund solution out first. Why was that? Like, what was behind that?
I just think in New Zealand we've had this transition, right, from where portfolios had this really big home country bias to one where people today are really investing their portfolios globally, right? And so today, the biggest portion of an investor's portfolio is global shares. So for me, that was the most important thing to focus on. And you know, the other thing about that is, you know, it is a sector that's so hard to get right. You know, people look at, say, the NZX 50, it's 50 companies, it's one country. You know, the global share market is, 3,000 companies. It's, 60 countries. So there's just so many more moving parts around a global shares portfolio, and that's why it is so hard to continuously get right. And the fact that we had Wilshire there as a partner, I looked at us as a business and thought, this is the area that people need to get right in their portfolios and need some global expertise around. And at the same time, we've really positioned ourselves well to capitalise on that for them.
Yeah. And this whole concept of style is really important, right? Because I know my last business that I had where we were doing fund hosting, so building funds for global managers coming into NZ, I remember during the period around 2019 through to 2022, we just had lots of growth managers coming through, right? All of them had really impressive performance track records and had done really well, but definitely had a way of managing money. And I guess that presents real challenges for investors, right, in terms of the temptation to chase performance within those sort of managers.
Yeah, although it's tedious, every single thing that we release, what do we have to put on the bottom? Past performance is no indicator of future performance. And I suppose it's on everything, so people naturally overlook it. Yep. But there's a reason that you do need to put that. It's because when you look at the academic research, following a fund that's won means nothing for the future, right? When you go into a fund, you are buying the future performance. You're not buying the past performance. It might give you a little bit of comfort. But to just take that to its extreme, there's some more research, and Morningstar did a piece just a couple of years ago looking at why an investor's money-weighted return in a fund is so much worse than the time-weighted return of the fund. And essentially what this found is that as a fund is successful, it gains more money. So the periods that they actually outperform, there tend to be less investors in them. And when they actually underperform, there tends to be more. And they took this research to its extreme. If you remember during COVID, one of the big ETFs, you talk about growth, this is growth on steroids. One of the big ETFs out there that was popular was the ARK Innovation ETF, right? That was just going to the moon, And the thing is, when you aim for the moon, sometimes you don't quite get there and you can fall. And what they found with that particular ETF is that an investor's money-weighted return was just so far away from the time-weighted return of the fund. If you'd been in there day one, you've actually done okay. But what the research found is people tended to crowd in once the returns had kind of already been generated. And as that style of investing came out of favour when we saw interest rates come up quite dramatically and valuations come back down to earth, investors, really struggled as a result. So you talk about style, that's something at its extreme, but it is one where every day, investors will go into a fund based off performance, and that isn't necessarily the best thing to do.
Yeah. I guess just take me through a real basic thing of style though, like we talk about it. What styles are there in terms of investment managers?
So every manager, no matter what they tell you, will have an environment where they will do better and an environment where they will do worse. Now, sometimes if you've gone good for quite a good period of time, you might fool yourself into saying, we're good no matter what the weather. But the reality is, if you're doing something actively, you're making a decision based off a framework or a style, right? So the ones that you hear about a lot are growth and value, but there's lots more than that, right? There's momentum, there's top-down, there's macro input. There's lots of different things that managers do, and it impacts the type of stocks that you buy. Now, when I was coming through the ranks early in my career, one stock that just completely split the market in New Zealand was Xero. Right. Now, this was a market that didn't have many growth managers. Lots of the managers in New Zealand were quite valuation focused, and that was a function of the market, right? If you look at New Zealand, there's lots of stocks like back then it was kind of, telecom was still around. You got Fletcher Building, you didn't even have all the electricity generators because that was pre when they were kind of sold off by the government. But you had managers that were really used to a more valuation strict framework. And then a stock comes through called Xero, right? And Xero had barely any revenue. Right. It had quite a high valuation. And I can remember going to different managers around New Zealand. The ones who bought it were buying it because they could see the growth trajectory of the business. And they had a framework that recognised revenue growth and earnings growth, which, they were massively pre-earnings back then. But then you had managers who were a more value style who'd say, I'll never buy Xero because it makes no money. And it, quite frankly, doesn't make a lot of revenue. So they weren't looking at some of those intangible factors that a growth manager would look at. So if you're a value manager at that time, your style was just out of favour because you had this one stock ripping through the index, being the largest contributor to return, and you wouldn't hold it.
So that almost sounds like an investment thesis run by accountants, really, when you talk about value, right?
Yeah.
These are people who love looking at this year's earnings of a company, understanding how much they're paying for it. So they're almost like bookkeeper fund managers in the way they think about companies.
Yeah, they definitely are, whereas you get growth managers who will more think about how a company's earnings profile might develop over time. To be fair to the value guys, they still do that, but with them, the proof is more in the pudding as opposed to, waiting or expecting things to kind of unfold in a certain way. Now, Anthony, I use Xero as an example, which was, a Kiwi example. But just think about how more complicated this gets if we start to think globally, if we start thinking about that dynamic but happening across 60 different countries. So if I go to 2024, that was when the Magnificent Seven stocks just ripped through the index. They drove a very large portion of index return. Now, these were companies at the time that were trading for anywhere between 30 times earnings and 100 times earnings. Now, a value manager going through is just going to look at that valuation and go, I don't care how good the company is or how good you tell me the company is. That valuation is just too high for me to invest into. So during that period, when those stocks were ripping higher, they found things really, really difficult, right? So every manager at its core will have will be predisposed to stocks of different types, and there'll be types when the market favours some over the other. So if you're sitting here today, and we record this on April Fool's Day, hopefully you find none of what we say kind of funny or wrong. But as we sit here today, we have been in a massive value market the past 5 years, right? We've had the value managers that are available in New Zealand, which aren't many, there's a handful of them, do really well. And you've had growth managers, which is most of the market in New Zealand. For some reason, we just have more growth managers here than value managers when we look globally. Maybe it's that whole time-weighted thing, right? You said they worked so well to the end of 2020. Those value managers have done super well relative to the growth managers. But again, these things happen in cycles. So we tend to get people, again, more focused on the value managers right now. And the cycle becomes self-perpetuating. And look, that's one of the reasons why with our fund, I really wanted us to get that mix of styles. So when an investor invests in our fund, there's lots going on within it, right? We've got a value manager, a growth manager. We've got a core manager, which is quantitative, more quantitative in style. So there's lots of stuff going on underneath, right? It's like the duck, under the water, the legs are going furiously, but, above the water, you just see a graceful duck kind of wading through the water. That is the aim with our fund, bringing those styles together so investors don't really don't have to deal with that noise, and where they're looking for them, making sure that those styles blend together in quite a complementary way.
Yeah, and it's really interesting because it was obvious from my perspective when we saw these growth managers coming through, when their style was working, that they really had a way of looking at companies that led them to things like tech stocks, right, and the Magnificent Seven sort of stocks, and that would then drive their performance. But it fascinated me how those managers were quick to try and disguise their style. You used the word all-weather. You'd hear that all the time. They would talk about their ability to perform well, even in negative markets. And I'd find myself staring at them thinking, this is largely an outcome of how you think about the companies you like. And you'd hear value managers that at the same time who are great investors, right? But their style just didn't work in that market environment. It didn't mean they couldn't outperform, add value for their clients. It's just that the tide was really against them. And so I guess in building the Aurellan funds, you've talked briefly about how you've put managers together who've got those different styles and bringing them together so you get the best of both worlds and coverage of companies into both sectors. It sort of sounds easy, but, take me through sort of more complex bits of that when you're thinking about it from a portfolio construction sense. Yeah,
so I think just to touch on what you said earlier, Anthony, because I just think it's an excellent point, is, during COVID, we had a downturn. But it was a really weird downturn, right, in the sense that everything got shut down.
Yep.
And you had growth managers doing way better than value managers in that particular downturn because the value managers tended to hold more asset-heavy companies like banks, which weren't going well because banks essentially sell money and money was free, so interest rates were zero, wasn't good for them. They tend to have more commodity-focused stocks. Remember, the oil price went negative for a bit there, wasn't good for them. Then you had tech companies, which actually did extremely well because a lot of people were still able to consume their goods and services from home. Now tell me, is the right conclusion to draw from that that a growth manager has better downside protection than a value manager. Absolutely not, right? Because every up market and down market is different. Let's talk about today. We've just gone through a horrible month in markets. Values tended to do better than growth because this has been an inflation shock where commodity prices have gone up, the opposite of COVID. So those stocks have done a little bit better. So look, every up and down market's different. It's not as easy as going, we'll have a little bit of value, a little bit of growth, a little bit of core. When we put together a portfolio, it has to be so much more deeper than that. So when we're constructing a portfolio, the first thing we're doing when we talk to Wilshire is going to them, you meet managers all around the world. Give us a list of your best ones. And look, for us in our process, that was a long list of about 30 managers. Now, that's interesting. It's probably more than the amount of global equity strategies that are available in New Zealand. And the nature of their global research was such that, I'm someone who's done multi-manager funds my whole life. And two of the managers they put up, once we got really down to our shortlist, ones that I'd never heard with or dealt with before. So they're really going around the world trying to pick the best managers. But I think what's really important for people is that, of that kind of long list, short list, whatever you want to call it, of 30, you can't just blindly pick 3 of those managers and go, I'm picking 3 of the best managers. That's not going to give you a smooth ride in markets because you might pick 3 who do similar things. You might end up with structural biases in your portfolio. So your portfolio might be in 3 managers that tend to all be overweight the US or all underweight emerging markets or overweight tech stocks. So the blending of a portfolio is super important. And what we want, what we're really targeting is that for the long term, the analyst's ability to pick a good stock shines through. At the end of 5 years or 10 years, which I think is a pretty good time period to measure a global shares fund's performance, we don't want the outperformance to be due to a big bet, a big bet on software, tech, what have you. We want it to be down to the manager's ability to pick good stocks in their sectors. And what is a good stock? Well, it's a 3,000 stock index. There's going to be lots of different stocks in there that each manager will gravitate towards. Yes, towards, that was the right word. It's bringing those together. And what we find with our managers, since they do quite different things, not many of them tend to hold the same stocks.
Right.
So, what is a good stock can sometimes be an energy company. It can sometimes be a tech company. We have managers, since they view the world a different way, through different lenses, all of them, we will have in our portfolio a mix of those different stocks across sectors that should hopefully drive kind of performance forward.
Yeah. So an example of that, right, in the last podcast that we hosted, we had Sarah Ketterer from Causeway Capital, who we use for our within our fund, and her business has got very much a value focus in the way it picks stocks. I think the example she used was she could buy SAP, which is a business accounting software package, for something like 15 or 16 times earnings, that it was for the quality of the company, it was cheap to buy. And so she really liked it as a company. When she's picking stocks, or Causeway Capital are picking stocks like that within our fund, how many shares do they end up with out of that universe? She talked about a universe of 3,000 or so stocks. Like how many shares will they actually buy on behalf of our investors?
They'll tend to buy 50 or 60 companies, right? So something we track with our managers is something called active share. So that's essentially if you list the 60 stocks that Causeway Capital have and list the 3,200 or so stocks of the index, what's the commonality between the two? Now, the commonality between the Causeway Capital portfolio and the index, is about 8%. So 92% of their portfolio is different to the index. Right. So when they're constructing a portfolio, they're looking at the world through a lens of, what do I want to buy at decent prices that's going to deliver a good return to investors over the long term. They're less worried about any kind of momentum in markets, any fads. For example, they've been the manager in our portfolio that's done really well, right, in a period where value's done well, right, and our growth manager has had a tougher time, to be frank. So there's that offset because of their style. They're picking these stocks that have more valuation support. And because of their style, you'll tend to get different regional exposures. So when I look at their portfolio, they have about 20% kind of less than the index in a country like America. Right. So they tend to see more value outside the US. So these managers are really going around the world. Causeway Capital do it from their base in Los Angeles. They're going around the world looking for the best stocks, and their analysts are trying to uncover them.
Yeah. And on the other side of the equation, we've got a growth manager in Loomis Sales doing their way of choosing stocks, probably choosing similar amount of stocks in the portfolio, I assume.
Yep. Yeah, that's right. So similar size, a little bit more concentrated. Now, why we like them is because as a growth investor, sometimes you need to be really patient.
Yep.
And the good growth managers that I've observed through time are the ones that buy a company for their long-term prospects and almost act like private equity owners in their support of a company. So, Loomis Sales is a manager that each year they tend to turn over the portfolio 8%. So this is a measure that we use to look, which essentially looks at the trading activity of a manager relative to the amount that they manage. So of their portfolio, which is about 40 to 50 stocks at any one time, they'll tend to buy and sell 3 or 4 stocks a year.
Which isn't much, right?
It's not much at all. And that's because if you're investing in a company for growth, a lot of the time, quarterly performance outcomes aren't actually where a lot of the value is. You're investing in a company because you think there is a really strong terminal value there if they execute their growth strategy. So, they've got a really strong view at the moment in their portfolio around a couple of things. So they've got one of the largest stocks in the portfolio is Meta, otherwise known as Facebook. Probably should be called Facebook because the metaverse has been a very expensive lesson for them. But so when we talk to Loomis Sales about Meta, they really like them as an AI play. Because with AI, you've got large language models, but what is valuable to an AI? It is the data. And Meta is... Facebook is a very large social networking platform, has a lot of information on the users, sometimes a scary amount, as a user yourself. But they've got a strong view that through time, they will be one of the key AI winners.
Yeah.
And so that's a really key theme going through their portfolio at the moment. They also like growth in Latin America. They see some good demographic trends that will evolve through time. And demographics are fantastic. They don't move anything short term, but they're very easy to predict long term. You look at things like birth rates today, that's your demographics of the future. So they see one of the key things that they can do in a portfolio is to have a time period bias over other investors. They see patience as a commodity that is not well used today. Yeah. And by them being more patient, doing in-depth research and focusing on long-term structural trends, that is how they will aim to outperform over the long term. But Anthony, that style I've just described, by its very nature, right, it's going to go in and out of favour, and they're definitely not chasing any trends in their portfolio. I mean, you don't do that if you're selling 3 to 4 stocks.
Well, I think the point there, Chris, is it's not so much their style that goes in and out of favour per se. It's the companies that they gravitate towards, and because they're a patient investor, those companies, there'll be certain points in time, those companies won't be the sort of market darlings and the favourite things, right? And for them to be really patient through time, as you've explained, they just have to accept as an investment manager that at times they will underperform the market in the short or even the medium term, right? So they have to sit true to style, true to the way they think about those companies and hold them through thick and thin, because they know that over time those companies will win out.
Yeah, and Anthony, that is something that, you tend to get a lot of pushback from investors on, because a lot of investors, if I explain that, they go, well, that's stupid. Why would you hold something that you know is out of favour? Now, the thing with that is that there's a couple of things with that. One, markets are very quick to reprice and to move. The second thing is, I've met thousands of managers throughout my life, as you would have, and Welsh has met thousands and thousands more. Investors who can actually move from a top-down level and move from what's working or not working to what's working, I've just seen so many try and fail. So what I've seen actually succeed better through time is people that are fundamentally good at what they do. And if you're fundamentally good at what you do, through time, you should deliver good outcomes. You'll just do it in a return profile that's different to, say, a value manager that should still deliver good outcomes through time, but do it in a completely different return profile. Now, I remember many years ago, we looked at this at a previous employer and looked and said, actually, let's get a top-down manager in our portfolio, someone that does try and pick these different regimes.
Right, and switch and swap.
Yeah, so 1 week they're value, then they might go into energy and let's try and time the market and do it. And it's interesting because a manager can do that for a certain period of time, and I can think of some in the market today that have this particular style that have struggled. A manager can do it for a period of time, and people go, wow, this manager has the one. They've cracked it. They've got the algorithm. They've solved it all. But then, you talked about all weather.
Yeah.
Then they find, the forecast is such that it's just something they'd never anticipated.
Yeah.
And they get the market wrong, or they're early. And actually, that's even tougher, because when I invest in a manager like that, I go, well, what are you?
Yeah.
How do I know how you're going to perform relative to the others? So those ones, in my view, and from experience, and like most experiences, the ones that you learn the hardest way are the ones where you still wear the scars from. Those managers, a manager from the top down, it's very, very, very hard to do.
Well, I guess bringing that back to Aurellan's solution around global shares, we've got a fund. I think you've highlighted that we've got a value manager, Causeway Capital. We've got Loomis Sales, completely opposite with a high growth focus. In the middle, LA Capital with a core quantitative focus inside of there, really so that we've got a portfolio that will ride through those different cycles, still outperform because they're all great managers that can still add value in the long term. It sort of sounds simplistic, right? What are some of the challenges that you've seen through your career in terms of funds like this, where they've gone right, where they've gone wrong, I guess, in terms of that?
Yeah, I suppose this goes to the heart of why we've structured our fund the way we have, right? So there is always a temptation in any industry to be overly driven by cost, right? Because sometimes the managers you want aren't the managers that you can afford, and you might make more money business-wise by investing in a cheaper manager. But again, this is short-term versus long-term, right? And something we wanted to be was very long-term in our thinking. So, separating our fees from the manager fees is something that we saw a lot offshore, right, when we looked to start Aurellan, but wasn't practiced here in New Zealand. So that's something that we wanted to bring, because that's aligning ourselves in a way where we can actually just pick the best managers. Some of them may cost more, some of them may cost less, and bring them to our investors and really do what has worked really well for Wilshire, doing the exact same thing for slightly different portfolios, but doing the exact same thing and picking good global managers, and us just doing the same for New Zealand. So I think cost gets in the way. Cost is important in a portfolio, so is tax, which we're both very passionate about. And people can focus on that as a, people focus on it because it's a controllable, and I completely get that. And we go really hard with our managers and use all our heft that we get with Wilshire to get absolutely the best possible kind of fees that we can. I think another thing where people can go awry is just it is so hard to pick with a manager what is luck and what is skill.
Right.
So we do a lot of work with Wilshire. We use quantitative and qualitative tools to determine what is luck and what is skill. So what I mean by that is when we're looking at a manager's performance, we're not looking at simply did they out or underperform. We're looking at what are the drivers of that. How much of that is down to picking a sector, picking a region? How much of it was down to any one individual stock? So we're looking at things like how did their average stock do? What's their batting average? How many outperformed versus underperformed? We style adjust their performance and go, actually, how is this manager done relative to any other manager? So, Causeway Capital at the moment, if it was offered as a standalone strategy in New Zealand, everyone will be piling in because its performance numbers are so good. But for us, we look at it and go, okay, they've done really well. Over the past year, done extremely well. But actually, they've done well, very well relative to the index. They've done a little bit better than your average value manager, but the key reason they outperformed is because they're a value manager.
Yeah.
So it's making these distinctions over what is skill and what is luck. And that actually takes a lot more work than people think, and it's a lot more complex than people think overall. So once we do that, it's really around making sure we blend the styles well, because that's an area that you can go wrong. You can still have a multi-manager that has a style bias kind of within it. So we want our portfolio to be style neutral. We want to test it versus what's happened in the past, but also test it over what could happen in the future. Because the interesting, is that old saying in the industry, history doesn't repeat, sometimes it rhymes, and so whatever happens in the future is typically not quite what happened in the past. So doing historical stress testing is great, but you've actually got to look forward and do some forward-looking stress testing as well.
I love the royal use of we too, because, clearly this is all about Aurellan and us building our funds, but we're partnered with Wilshire, right? And in that we, you're talking also about the expertise that Wilshire bring, whether it be through Rob Nyes that you had on a podcast, I think it was late last year, his team doing all the manager research, so they're out there kicking the tyres, assessing all the managers on our behalf essentially, so massive team doing that. through to David Johnson, who's got the expertise that you're leveraging in terms of blending those managers together, all the rocket science that they bring, and they really are rocket scientists, right? They've got links to NASA in terms of blending those. And you, through your experience, obviously watching them do it, testing how they've thought about it to bring it together as a structure that's appropriate for our investors in NZ. You know, you've talked about our common sort of passion and interest in tax, those sort of issues coming into play in the portfolio that we're actually building. And so, interesting. And I think another thing that you touched on there is around also the limitations, I guess. Well, one of the things that we've solved for is often as an investor, you can only really choose, if you think about tax, right? You suddenly go, oh, I want an investment manager who's got a fund appropriate for me as a New Zealand investor. There's a very limited universe of funds that are out there and available.
Yeah.
Whereas we've sort of turned it on its head. We've built our own fund here with all the tax benefits of having a New Zealand PI fund. And then we've got the ability to plug any manager we like from around the world into that. So we've ended up with 3 managers, but out of a universe that Wilshire looks at of what? There's
it's thousands.
Thousands, right?
It is thousands. So, that's really handy, right? Because you do get, particularly in New Zealand at the moment, you do get some offshore managers coming over and wanting to have a chat. So it's really handy for us. We just look at the Wilshire database and go, okay, what does Wilshire think of this manager? And I think Rob touched on this in his in the podcast we did with him, is with a manager, they'll often come to you when performance is good.
Yep.
And they'll
which
often
is that experience I talked about.
Correct. And they'll have a sales pitch,
yes,
which, is tried and true and impressive. So often it's hard to not be impressed when you're sitting alongside a manager, but the reality is the really good active managers are actually really rare, when you look at the statistics. And it's actually things like alignment that go a long way. It's the lens of what they do differently relative to any other manager around the world. And when you see enough of the managers, you kind of go, oh, yeah, I know this manager. They do a really similar thing to another manager. So it's super important for both us and Wilshire is for the manager that you look at, you've got to go, what does this manager do that is different than any other manager around the world? Because that is alpha. That is true outperformance. So we look at that for each and every one of our managers. But the other thing we look at, because in this industry, and we've touched on it a bit, is people can sometimes be blinded by their own brilliance, right? Yeah. So you would have seen lots of growth managers in 2020, 2021. I bet you not one of them said to you, Anthony, we've had such a good time because all the growth stocks are going up because interest rates are zero.
Yeah. And they all talked about being all-weather managers. And there was a forum in Wellington here actually the other day, and someone attended it who then talked to me afterwards. I know they're an investment advisor. They said, there were 3 great managers speaking at this thing today. And I said, well, what sort of managers were they? And they said, they've got this sort of all-weather approach to investing and things. I said, well, I actually know who they were, and they're value managers. Didn't they actually name what they were? And the person reflected on it, and they were a bright person in the investment community, and they said, actually, you're right. They are all value managers, and it's interesting. I think fundamentally to be a good, global equity manager, you have to believe that you are actually to be one, you've got to believe that you are the very best one in the whole world. It's sort of part of your thing. So I think that leads to that whole thing of believing that your style's going to almost disguising it, I guess.
Yeah, there's a bit of hubris there, right? When I outperform at superior skill, when I underperform, it's all because of the style, right? That's why in Wilshire's process, and this is what I loved when I went deep into their manager research process, this is actually something they look at a lot. So they have a part of their manager research framework called attribution. So, and it's not about having an attribution model, because any manager can show you they got some numbers, they run through an attribution model. It's how their previous decisions are audited and attributed. So the really good managers Wilshire have found are the ones that actually know the reasons that they've out or underperformed. And if they've outperformed, they're humble as to why and understand the drivers. And if they've underperformed, they're not just saying it's bad luck. They're looking at and analysing their decision-making process to where they could have done things better so they can improve into the future. And again, just think about, the managers that you've talked to throughout the years. That's not something that a lot of managers actually do. So it's interesting when assessing New Zealand managers, which I've done for many, many years now. That's something that we've really embedded into our process to align ourselves with Wilshire. Yeah,
and the attribution thing you're talking about, and would be people saying things like, look, we did really well against, say, the benchmark, but some of our decisions actually weren't that great given our investment process or focus. We could have done better almost inside it. It's having that self-reflection to understand what's really driven your performance.
Yeah, so think of 2024. You could just be overweight the tech sector because you like the tech sector, right? Tech sector outperformed all other sectors that year. Yeah. Right? So that's outperformance due to sector allocation. It could be that within the tech sector, you actually didn't pick the best stocks at all, but just because you were in a sector that had tailwinds due to AI, the stocks went up, right? Is that skill? Is it getting lucky on a trend? It could be a combination of all. It's about a manager going, why did we go into the tech sector? Did we actually see this AI thing coming? Or do we have a completely different thesis that didn't come true, but we just got lucky? Yeah. So these are the things that are really important to understand, because there's always themes in the market. Today it's energy. 24, 25, it was AI. In 2020, 2021, it was all about stocks that benefited from people staying at home, right? Then you had kind of, after the global financial crisis, it was all the move to digital platforms and the emergence of people utilising the internet in more in-depth ways. It was, the advent of software as a service companies. There is always themes in the market that will drive returns. Our job and Wilshire's job is to ensure that we're picking managers that will benefit from a range of those tailwinds, because you never know what the next key driver of markets will be.
Yeah. But we've got confidence inside of that they're all great managers. They'll just perform differently through time. So they will win eventually or ultimately, regardless of their style. It will just be at different times. Hence that diversification benefit of putting them together in a single solution.
Yeah, so obviously it's what we aim to do. It's what we do lots of research to try and achieve. So, yeah. That is the crux of what we're trying to achieve in the fund.
So shall we bring things to a close with a couple of questions?
Yes.
I guess if you hadn't done investment management, what do you think you would do? Or if you weren't doing investment management?
I think I would have ended up working somewhere in the fishing industry, as
back to the family business.
That sounds,
to Leva, Island Bay. I understand.
Yeah, it was a pretty formative kind of experience for me, working with family within the fishing industry. And as you know, with me, I love characters. and you have to be slightly mad to be like an oyster shucker or a fisherman or something like that. So I enjoy the liveliness of those kind of people. But, there's parallels, right? Because me, I love people. I do it at the end of the day, the job, because I want to get good outcomes for people. And I'd probably be stinking of fish, and my wife would probably like me a little bit less and send me to the shower as soon as I get home, like the good old days.
And it's probably rude to say it, but 37 now, Chris, sort of long-term outlook for Aurellan as a business. We set Aurellan up quite a while ago now. It's amazing how time flies when you're having fun. Where do you see the business going to what's the outlook going forward for Aurellan?
So it's super interesting because, when we first launched Aurellan, I had some really nice messages from just people who I've worked with throughout the years. And one of the messages was actually from my first boss at Mercer, someone who interviewed me, and her name's Vicky, and Vicky said to me, I always knew that this is something that you wanted to do and you were going to do. And for me, that kind of brought it back right to the beginning. And I apparently at the interview, as a 21-year-old, she asked me, where do you see yourself in 10 years' time? And I said, well, maybe in 20 years' time, I'd love to run my own funds management firm because I really like helping people, but I need to get the skills to be able to do that. And it didn't quite take 2 decades. I think here we are, kind of 16 years later, kind of launching Aurellan. And for me, at the age of 37, it's something that I see myself doing for the next 30 or 40 years.
Yeah.
And that has framed the thinking around what we do. We're probably not going to be the shop that is quick to the market with 10 new funds or 20 new funds. The nature of our business of co-investing with our investors, having we're seeding each and every one of our funds, and we will continue to do with our own money, being the shareholders' money of Aurellan. And that's, again, a very long-term decision, and probably means that we won't do something until we feel like 100% we can do it properly. And that might sound like a really fluffy notion, but look at the Global Shares Fund. We've got segregated mandates with 3 of, the great, in my view, managers from around the world. 2 of them employee-owned boutiques. 2 of them only run one strategy, right? These are people who live and breathe their one strategy. They're not product manufacturers that pop out 100 or 200 different funds. With what we're doing in private markets at the moment, we've looked at so much. We've put so much work into things that we haven't ended up doing in the space as much as things that we have ended up doing in the space. So my vision for the firm is to keep doing that. Everything we bring to market is not a product in the sense that it is something that we have to be happy to invest into as well, and something that is there for 10 years, 20 years, 30 years, 40 years. So I'm super excited to do that. I hope you're with me for as many of those 30 or 40 years as possible. We might have to talk to Emma about that. But that's the setup.
But for me, it's a real thing, right? We're talking about a business that will exist a long time past my physical life, and I find that really cool to work on. And obviously, for people like myself and Campbell, our fellow founder and shareholder, we're also interested in that from management of our own wealth in terms of, the future generations of Edmonds and things have got a vested interest in terms of what we're doing, because Aurellan will go on still managing those portfolios long after I've retired, to whatever I end up doing through that time. So, it will be a great journey to be on. So,
Yeah, and look, hopefully, one day my kids get into it because, we're just setting them up with Invest Now accounts, and it's quite hilarious because my oldest Lucas says, "Daddy, how much money do I have now?" Every day. So he's still in the phase of
you've got a bit of training to do.
Markets a bit too much, and as we record this, having gone through March, he started to lose interest, and I've said, "Well, Luca, it's gone down." And he says, "Well, Daddy, do I still pay you a fee?" And I said, "Well, yes, unfortunately you do." And actually the tax system means that you pay tax, but that's all a little bit complicated for him. But it is like it's a pleasure, right, to do this sort of thing, and it's a privilege. And we're super lucky, actually, that of the people we have around us, and also, just kind of 3.5 months in that, people have trusted us with very substantial family wealth. So that's super cool too. So the next 10, 20, 30 years is really going to be repaying those people who have given us that early support.
Yeah, great. Oh, well, let's crack on and get into it.
Let's do it.
So thanks for joining us again for one of our podcasts. Hopefully you found that really interesting and insightful. Join us again for our next episode of Intergenerational Thinking on our podcast series. Thanks.
Thanks for listening to the Aurellan podcast. Everything we've shared is general information only, not financial advice. If you'd like guidance in your own situation, please talk to a licensed financial advisor.